Oh, yes, we are live. Oh my gosh, they don't want me to tell the secret, but I gotta tell them because I can't stand people being misled. Woo, this one right here, I know it's gonna touch some people the wrong way, but I do not care because I want people to be able to make the right decision for them and their families with having all the information. So today's topic is whole life insurance. I know that y'all seen the videos out there. I know y'all seen them where they are talking about no one should have whole life insurance. And then to top it off, they show a video of somebody who has been sold a whole life policy and there's no cash value in the cash value account. You hate to see it. You hate to see it. But what happens is two different things. One, somebody could have been sold the wrong type of whole life policy. Or number two, or the person is unhealthy and that's the only thing that they could get is a whole life policy. Because with term policies, you have to be healthy. Emphasis on healthy, okay? So today we're going to jump into the types of whole life policy and why one may be a better fit than the other, or why it might not be a good fit at all yet, okay? So, first, the traditional whole life policy. Is for people that are healthy. That means they have health conditions and they don't qualify for term. Or two, they're getting a little bit older now. And so them passing is a real life thing. Typically, we look at the age 65 of being that mark where a person transitions from term to whole life insurance. Okay. So now that we've got that out the way, the other type of policy, the other one that they're not talking about in these videos, but they're comparing the product to is the IBC, the infinite banking concept. Okay. It's almost like saying, you should never wear hiking boots. Well, if you're going hiking, you kind of want to get some hiking boots, you feel me? But if you're going to a formal dinner, you might not want to have on hiking boots. But that's what they're doing here. They are trying to compare two separate products for two separate uses together to convince you to buy whatever product they're trying to get you to buy. And that's not how it should be. You should be able to look at the different products for yourself and make that decision along with a little bit of information like I'm giving you here. Okay? So, the IBC. What is it and how does it work? Okay? An infinite banking concept is a whole life product with the intent to build high early cash value. Okay? So, when you get this infinite banking concept policy, what's going to happen is every $100 you put in within about 15 days, you will have access to 70 or 90% of that money. Okay. The second thing is as your policy grows, meaning every time you make that payment, what happens is you're going to see about a 5% return per year on that policy. Okay. Now you'll see these other people saying, but you got to pay interest if you take a loan. Yes, yes, you do, because you pay interest on everything, whether you see it or not. So let's go ahead and dive into that since that's what they want to bring up is you're not going to have any cash value and then you're going to have to take interest if you pay for a loan. Okay. So we've already talked about the cash value in this IBC policy. We've already discussed that you're going to have access to 70 or 90% of whatever you put into the policy, plus it's going to grow at about 5% per year. Now let's talk about that interest. So let's say you've paid on this policy for a little while now, you got $20,000 in this policy, okay? Now, you being the smart individual that you are, you're looking to make some passive income. So, you are now looking to go out and buy some vending machines, okay? So, say $20,000 worth of vending machines. Don't know how much that's going to get you. Let's just say three, because that part does not matter. Now, if you go to the bank and say, "Hi, Mr. Bank person, I want to get a loan for $20,000. They're going to give you a few options. One, your credit is horrible. You need to work on it so we can't give you a loan. Sad to hear it. Sad to hear it. But what can you do? The second option is your credit is a little shaky. It's just a little shaky. So what are they going to say? Well, you know, mm, your credit's not the best. So let's go ahead and say We'll give you a loan at 5% on that $20,000. I mean, at least you're gonna get your vending machines. You're paying a little interest, so what? You'll make that back. Nothing but a little check, right? Or you got good credit, and now they're gonna say, okay, we'll give it to you at, let's just say, 3%. Okay, all right, cool. You got to pay a little interest to get a little loan. That's fine. Okay, so you have two options. You can take one of those three deals that they're going to give you, or you have your IBC policy over here. Okay, with the IBC, they say do not take that loan because you have to pay it back. While that is somewhat true, you do got to kind of pay it back. Here is what really happens. Okay, so say your death benefit on this IBC policy is $300,000. Okay, you take that $20,000 loan. The moment you take the loan, you go home, you get hit in a car accident. Okay, as soon as you bought the vending machines, 20,000 gone, you get in a wreck in a car accident. What happens to the money? Well, they take that $300,000, right? They subtract the $20,000. Boom, bam, your family gets $280,000. But they said that you had to pay back that loan. Nope, they just took the money. They just took it out of the death benefit. That's exactly what happened. Or here we go. Now you bought the vending machines. You got $20,000 loan. They're charging you 3% interest because that's what the interest rate is at on the IBC. Could be a little bit more, could be a little bit less, just depends on your policy. So that number is not set in stone. But let's just say your policy is 3%. Okay. So the question is, what if you're going to pay 3% back to the insurance company? Why wouldn't you just get the loan? Well, because that $20,000 gets paid to you. Okay. If something happens to you, your family is not responsible for that $20,000 that you owe the bank because it's just going to come out of the life insurance policy. But you're also getting 5% on the money that is in the account. So your account is growing, okay, by 5% while you have that 3% difference. So you just took a loan that is essentially they're paying you 2% on. Now, see, that's where the magic is. Now, when they tell you you should never have a whole life policy, they're basically setting you up for a situation. When they're telling you you should never have a whole life policy, you should never have a traditional whole life policy when you're young and healthy. That itself is the key. So I hope that this gave you the information you needed to decide if you want to make the choice yourself. Now, if you want to just dig into it a little bit deeper and find out, what policy might be the best for you and your family and your goals that you would like to achieve, feel free to leave me a message, leave me a comment, or go to c4quotes.com and do the quote yourself because those other people aren't going to go let you run all the quotes yourself to see if you're paying the best price, to see if you got the right policy. They're just going to tell you that you got the right policy, just like they told you you should never have whole life insurance. So, as always, stay wealthy, my friends, and stay blessed. Until the next one, please leave me a like and a comment and let me know if this video was beneficial. And as always, see you soon. Peace.